Welcome back, everyone. Today I'm going to do a quick video, basically a screen on my computer of what's going to go on with FOMC meeting tomorrow. That's September 20th at 2 o'clock p.m. Eastern Standard Time. And at 2:30, there's going to be the press conference with the chairman of Fed, Jay Powell. So I've been able to get, I think, every single one of these right, and maybe I'm just lucky, or maybe I'm just looking at the probabilities. But what's changed lately is that we've gotten from consistently raising rates, and that's what I've been saying, to raise rates and then pause, raise rates and then pause. So before I looked up the historical history, basically, of when the Fed raised rates, I was going to predict in this video that the Fed would raise rates. However, I saw that they raised them last time, so that means they're going to pause this time. And if you look here, this is a probability, and I'm showing it to you in a different way. Most people just show you one bar chart. What I'm showing you here with these bar charts with the lighter colors getting to the darker colors are recent history. So basically, on August 18th, there was an 89% probability of the Fed pausing rates, and that's gone up to 92, then 98, and now it's 99%. It's basically not even a probability, right? It's like for certain that the Fed's not going to raise rates for this meeting. And if you look here, this is a National Financial Conditions Index, also called NFCI, out of Chicago, and there's various services that show you this. If you look here, and where my pointer is, it's gone down. It's showing that financial conditions are getting easier, but I'm seeing contradictory information. For example, if you look at this is the Fed's balance sheet. It says assets, total assets. All this means here, total assets less eliminations. What this really means is the Fed balance sheet. And you can see it on top here, total assets. So that's the Fed's balance sheet. If you look here on the right where my pointer is, it peaked in March, and that was no coincidence. That was a Silicon Valley / regional banking crisis. And what the Fed did is they actually increased liquidity, and that's why the Fed balance sheet went up. But since then, it's been going down. You see it was 8.7, then 8.6, and then 8.3, and now we're down to almost $8 trillion. So it looks like we're going to keep going down consistently. And so this is hawkish. Next chart. And speaking of being hawkish and having a hard time for the economy, the latest reading, was issued in July, of the loan service survey, and there's a million charts that go with this, but they all look the same. Basically, this line's gone up. And every time this line goes up above 60, there's a recession. So there's one here, one in 2008, one in 2001, and one back here in 1990. I don't have bars for the recession, but that's where they were if you look it up. So again, I think this is all hawkish. And let's go to the next chart. And speaking of hawkish, the U.S. inflation rate, there's a lot of ways of measuring it. This is year over year, core and CPI headline. And as you can see, the headline number is up 3.7, and that's too high. The Fed says they want inflation to be no higher than 2%. And what's concerning is the core CPI is at 4.4%. So that's way, way too high. And by the way, this chart comes to you courtesy of Charlie Bellello. And if you look at energy cost, and you have to remember, energy cost of feedstocks for many items, including items that are excluded in the CPI. So when you look at looking at the core PCE or the core CPI, they exclude energy, but energy still has a way of working its way into the headline number. And you could see it's been like skyrocketing. It was around 60, maybe a little higher, and it's going up towards, marching towards $100 a barrel. And that's because, as you know, OPEC Plus has been cutting production. And at the same time, so supply is going down. And the strategic reserve is filling up. And at the same time, the demand is increasing. I think we're at actually an all-time high for oil demand in the United States, which no one talks about. And what's truly concerning to me is a truflation rate. I look at this one all the time when I want to know where the direction of CPI is going, and this has kept going down forever, and all of a sudden, in mid-August, it started popping up, even before, I think that's even before the rise in oil prices. Let's see that. Yeah, it seemed to go, actually it is reflecting oil prices, but it could be reflecting other things. Actually, if you go down here, you can see when you click here on the left side, you could actually see what's turning around. So housing, for example, is no longer going down. Transport's no longer go down. Of course, that's reflecting oil. Utilities, they're still going down. Healthcare, still going down. Household items going down. Clothing going down. Alcohol going down. Education, recreation. Wow, recreation's really going down. So the biggies are I guess, oil related, and like I said, transportation, which is oil related. So those are the ones you got to watch out for. So let's go to the next chart. So this is a great website, Trade Economics, and you can actually, just for the United States, you can choose prices. And this is all inflation data. And I'm not going to read every one to you, but what I want you to notice is that the Fed wants, meaning Jay Powell, wants 2% inflation. But almost every single data point has year-over-year inflation greater than 2%. Now, some of them are lower than 2% because they're not year-over-year. Like this one here is inflation rate month over month, so you got to skip that. So this one's year-over-year. That's 3.7. Then you've got core inflation rate, 4.3. Food inflation, 4.3. The core PCE, 4.2. Core PCE prices, quarter to quarter, 3.7. And it goes on and on. Okay, export prices are down. That's one that's down. Even the Michigan 5-year inflation expectations are above 2%, in either for both indices. And this, I'm not going to read every single one of them, but you can see rent inflation is huge. And the big one I want to focus on is rent inflation. I didn't talk to you about the unemployment rate or the labor market, but the labor market's been strong because of services, and the services economy has been what's been holding up this economy. And if you look at services inflation, it's very high. And if you look here, this is ISM services business activity, and this activity index came in at 57.3, which is above estimates, and it looks like it's actually trending up versus what we saw in April and May, and even February and March. That's a bad sign. So all this data, my friends, is saying that we are going to have higher than wanted inflation, meaning high inflation than what the Fed wants, and that's what we don't need. Like if I don't care about inflation being 5%, it doesn't mean anything, or you don't care. What's important is what the Fed, Jay Powell says. The Fed governor, Jay Powell, is saying, like I said a million times, and he said a million times, he really wants 2% inflation. And that's going to take a long time to get, because I think this is an analog to what we had in the 1940s, when inflation went down quickly and looked like we had a grip on inflation, and then started going up again. So I think it's going to be like a bouncing ball. It's going to take a while to actually go down to 2%. And so my last point to you was, and this is the most important point, and let me just find the calendar right here for you. This is the most important point. It's not what's going on at 2 o'clock. I think everyone's expecting, and it's not just me, that the rates are not going to go up. What's going to happen is at 2:30, the Fed Chair Powell is going to answer a lot of questions, and in those questions, he's going to say that, comments, I should say, that are hawkish. He's going to say that we're still not at 2%. He's going to talk about what I talked to you about, that the core inflation rate's too high, service inflation is too high, service wages are too high. He's going to give a lot of factors and data points pointing to to the fact that he wants inflation to come down and that he's just as hawkish as ever. So just remember that. And one last point I didn't talk about here was a dot plot. Maybe I could find a few. I think I have it here somewhere. Here it is, dot plot. This dot plot is from June. I think it's going to be revised. I think if you look at the Fed funds rate curve, I think it's coming down too fast, meaning investors expect rates to come down somewhat rapidly beginning as early as 2024. So I think what's going to happen is, like I said earlier, and the Fed said, the Fed's going to raise and then watch and then raise again and then just raise and hold. So I don't think rates are going to be coming down, which is indicative. And if you look at the probabilities from the Fed futures curve, they are not coming down. So I think, again, the Fed's going to be very hawkish, and that's what could hurt risk assets. It's not that rates are going up or they're staying unchanged. It's what he's going to say in the press release. Well, thank you all for listening, and good luck in your investments. Bye-bye.